Critics, including President Trump, charge that the Federal Reserve is keeping interest rates too high. Others say the Fed is correct that inflation is a threat. Here's why both views are right and what that means for the market. Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. In a recent interview with the New York Times, the Federal Reserve's newest governor, Stephen Miron, declared that the central bank should cut interest rates by 50 basis points at its meeting next month. He pooh-poohed concerns about inflation, warning that recession was the immediate threat, not a surge in prices. Meanwhile, the Fed's current boss, Jerome Powell, threw cold water on the idea that even a small reduction was a sure thing next month. Too much uncertainty about the state of the economy, he averred. The president and Miron are right. The cost of borrowing money is overpriced. Our rates are higher than those of Japan and the European Union and are about the same as Britain's. This is absurd, given that our fundamentals are so much better than these economies. Our artificially high cost of borrowing constricts lending to small businesses. This hurts both the availability of expansion capital and routine working capital. One fact to remember, by a wide margin, Hispanics start more businesses than any other ethnic group in the U.S., but they're held back by the difficulty of getting adequate bank financing. But defenders of the Fed's timid steps do have a point. The fires of inflation have not been extinguished. In fact, they will worsen if corrective action is not taken. What we're talking about here are not price rises because of tariffs or regulations or the severe disruptions to production from the pandemic lockdowns. The Fed can't control those. What it can control is monetary inflation. That is, the dollar losing value, usually, but not always, because too many are being created. Gold is traditionally the best barometer of monetary trouble. It has doubled in price in the past 2 years. This spells future inflation trouble. But this is where the Fed gets things profoundly wrong. The proper response to this threat is not to try to depress the economy. Prosperity does not cause inflation. What our central bank and the Treasury Department and President Trump should make clear is that we don't want a weak dollar because that would supposedly help reduce the trade deficit and boost the economy. President George Bush's economic team thought the same thing in the early 2000s, and that led to the disasters of 2008-2009. With a stable currency, you don't get monetary inflation. Now, this leads to a crucial question that the administration should push. Why does the Fed think manipulating interest rates is the best instrument to influence economic activity and fight inflation? Interest rates, after all, skyrocketed in the 1970s and early 1980s as inflation soared. Interest rates came down sharply after the summer of 1982, while inflation fell by a lot. Ultra-low and even zero or negative rates after the 2007-2009 economic crisis didn't stimulate an economic boom. They distorted financial markets and enabled enormous increases in debt, whose consequences have yet to fully play out. Before 2008, the preferred instrument to influence the economy and fight inflation was changes in the level of bank reserves. Hardly perfect, but far better than what's being done now. The bottom line for stocks and bonds to staying strong is to cut rates, go for a stable dollar, and keep cutting tax rates and regulations. Otherwise, this bull market is headed for the slaughterhouse. I'm Steve Forbes. Thanks for listening. Do send in your comments and suggestions, and I look forward to being with you soon again.